Hello everyone, guys. What if I tell you that by the 27th of 2000 gold and even Bitcoin will become real money? And all our fiat savings will turn into dust. The fact is that the whole world has been living on loan for a long time, money was printed, and debts grew. Now we are approaching what will be the biggest crisis since the First World War. We will be covered by the collapse of the credit bubble. In this video I will show graphs, facts and history. History says that this process will take at least years. Let's start with the Dow Jones to gold ratio. Why is this one of the most important charts right now? Because, in fact, it has been a benchmark for 130 years, both in the world of finance and in the world of investment, and few people look at the events taking place in this context. Gold, of course, has been the highest form of storing valuables or wealth for 5,000 years. This is the real money. After all, it was J.P. Morgan in 1912, speaking before the US Congress, who said, "Gold is money, and everything else is credit." The higher this ratio that you see on the screen inflates, the more inflated the credit bubble is. The fall in this ratio shows that the money bubble is bursting, and gold is becoming real money again. That's why we're looking at the Dow to gold ratio. Fortunately, we can go back more than 100 years to consider the behavior of this ratio. We have a lot of history here. Let's start with the credit boom that we have seen since the beginning of the First World War. It started about here in 1914, and as you can see, then this ratio was about 2.5. We see that over the years, the credit bubble has been inflated and deflated, but in general, all these processes were part of one credit cycle. Why did this ratio fall down in 1921? Because then there was a short-term depression that didn't last long. Why didn't it last long? Because the government and the US Federal Reserve have not yet learned how to mix in the market, and therefore, the markets simply cleared the surpluses of the previous credit bubble and did it very quickly. In other words, they reset the credit bubble that formed after the outbreak of the First World War. Everything has come to balance. But you will notice that this correction has not returned to the level it was when the First World War began. So it was just part of the credit bubble after the First World War. And then we watched the Roaring Twenties, which led to the inflating of a record credit bubble at that time. The debt-to-gold ratio has reached almost 20-1. At the beginning of the cycle, it was only 2.5-1. Insane growth. And it was in this credit bubble that everyone remembered that the real money is gold. This means that at the peak of this credit bubble, the Dow almost reached 400. The price of ounces of gold at the same time was about $20, which means that to buy the Dow, you had to give almost 20 ounces of gold. But then, of course, there was the stock market crash of 1929. I do not think that it was he who caused the collapse of the credit bubble, but rather the opposite situation is here. The collapsed credit bubble hit the market. Credit bubbles can exist for decades, but sooner or later they burst. Then we had, of course, the Great Depression. It was very cruel. Contrary to popular opinion, Herbert Hoover, the 31st President of the United States at that time, really interfered in the market at that time. The US government then pursued a bailout policy for many financial institutions, and the US Federal Reserve also began to help. Although it was not according to the rules at that time, they were not supposed to buy government bonds, but in 1935 year, they changed the rules and laws in order to do this. Anyway, when the Dow fell, this ratio also decreased, and the decline was quite sharp, but prolonged, smeared for years. This could be called a global zeroing from 20-1 to 2 and even lower to 1. This means that the Dow at the bottom was worth $40, whereas at the peak here, it was worth almost 400. And at the same moment, it was gold that became money again. And this was the first reset of finances, the first financial reset. 1933. Remember this date. Then the second credit cycle began, which lasted until February of 1966 year. Things went up again. A new credit peak was inflated for 33 years. Yes, there were small corrections of this ratio along the way, for example, in the 37th and 38th years. What is called the second wave of the Great Depression happened. It happened due to the fact that after a strong economic recovery in the 33rd and 36th years, the government began to reduce public spending, and the US Federal Reserve began to tighten monetary policy. But in the big picture, these corrections were part of one big cycle, which eventually peaked at 28-1. Why was it higher than the first peak? I think it's because in 1933, the United States abandoned the gold standard domestically. Yes, they still used the international gold standard, but the cancellation and domestic gold credit were enough for that credit boom, which is why it grew so much from the 33rd to the 66th. He lost one very important reason that was pushing him downwards. But as always, nothing lasts forever. And so we saw the collapse of the bubble, which lasted from 1966 to 1980. It took quite a long time, 14 whole years. The previous bubble, by the way, deflated in 4 years, not in 14 years. We see a pattern. The longer the credit bubble inflated, the longer it deflated. It's just natural. However, it also fell much lower than the first bottom. The minimum was below 1, according to this chart. Gold then rose to $850. After that, we saw the beginning of a new credit cycle and a new credit bubble, which continues to this day. In fact, someone might say that the peak was in 1999, right here, when the Dow Jones ratio to gold rose to 42 to 1. This was at the height of the dot-com bubble and the stock market. Since then, we can say that until the 2008 year, the credit bubble was in a state of collapse. But then what happened? Central banks have started experimenting with quantitative easing and money printing like never before. The scale was unprecedented. And that's why, since the year 2008, we have seen the restoration of this ratio. The central banks extended this credit cycle for a few more years after the financial crash of 2008, and therefore, we got a second peak in October 2018. And that's why it's useful to look at things in terms of their value in gold. When you look at the market against the dollar, you may even have the idea that we are in a bull market. But in relation to gold, no. I think one day we will look at everything from the point of view of the value of everything in Bitcoin, but that's another story. If we evaluate financial assets in relation to gold, a shocking fact opens up. Since 1999, financial assets have not been in a bull market if they are valued in gold. Yes, there was their recovery here, but it ended at the end of 2018. And it was almost completely dictated by central banks, money printing and so on. So, it took longer to reach the new peak of the credit cycle, because the government and central banks extended it much more actively. But I think, as this graph shows, the credit bubble is unfolding now. Perhaps this is what scares Trump when he literally demands intervention from the US Federal Reserve. He does not want such a collapse during his presidential term. He doesn't give a damn what happens after that. Either the US Federal Reserve is now intervening and prolonging the credit bubble for another couple of years, or the collapse began yesterday. Yes, it has begun, and it will not begin. However, the collapse, as can be seen from historical examples, will last for more than 1 year. At its bottom, the debt-to-gold ratio may fall again, say, to 1, even lower. Imagine, we may find ourselves in a situation where less than 1 ounce of gold will be given for a unit of the Dow Jones. This is quite possible in the future. So what about the timing? How long will this take? When will it start? Sometimes what's simple is brilliant, as they say. If you measure the period from 1933 to 1980, that's about 47 years. If you add 47 years to 1980, when the previous cycle ended and the current one began, you get 2027th year. Therefore, I don't think there is much time left for people to protect their credit investments, stocks, bonds, and so on. Again, it all depends on whether the US Federal Reserve intervenes in the near future, but even so it will delay the inevitable. Only for a couple of years. It should be borne in mind that historical timeframes are not accurate. So how do you protect yourself? Well, for example, you own a small amount of gold. Have you seen what they have already started doing in Europe? Gold is produced in the form of a chocolate bar, and each tile can be easily broken off. I think this is a hint that gold can become money again, just like it was at the bottom here and here. In China, for some reason, ATMs are installed in which you can hand over your gold for cash. The harsh truth is that many central banks themselves accumulate gold at a furious pace at the same time. They do not want their customers to buy gold. Why? Because they're afraid of him. When you buy gold, you take back control. But you also regain control when you buy Bitcoin. You just stop playing by their rules.